All right, so good evening, everybody, and welcome to another webinar that we host on a nice Tuesday evening. Tonight we're going to be talking about the basics of trading gold. But firstly, before I get into that, what I would like to just mention to you is if you could please just, for the guys that are trading various other products and you didn't happen to make any of the webinars that we've held previously, just remember that we have recorded all of these and they do get put onto our YouTube channel. So if you go onto YouTube and you can subscribe to our channel, which is free to do, if you just do a search for Official Trader 24, you will see all these various webinars that we have conducted in the past, ranging from how to trade forex, risk management, money management, various technical analysis techniques. So there is quite a bit of information there at your disposal. So just remember that going forward. All right, but just coming back to tonight, we will be talking about the basics of trading gold. Really, when it comes to things such as commodities, you need to have a fundamental understanding, obviously, of what you're trading there. All right, so I'm going to take you through a little bit of history, the fundamental story of gold, the relationships that it has with various other products, some technical factors, gold versus the mining stocks, and finally we're going to end up with some ETFs as well. All right, so just quickly, historically, the basis of the currency was gold until it was replaced by the fiat currency, which is money existing by the government decree. All right, and obviously this is the principle of the gold standard. Oh, that's what it was really, and then paper money that can always be reverted back to gold. That's what the gold standard was. All right, and the last country to abandon the gold standard was Switzerland in 1999, which is essentially still 40% backed. All right, okay. Gold is essentially a wealth asset. Unlike silver, which is prized for its wide industrial and pharmaceutical usage, gold is used predominantly for the purpose of wealth accumulation and preservation. Okay, so basically you're going to be seeing a lot of stats here tonight. Up to 2011, 171,300 tons was produced in human history, which is equivalent to 5.5 billion troy ounces. Basically, you will multiply national holdings by currency in issue. Okay, so if you had to clump that all together, it would basically be equivalent, and this is just anecdotal, but equivalent to a cube, which is 20.7 meters per side, which is sort of a hang of a lot smaller than that you would generally expect. Okay, basically, trading gold online needs a little bit more cash than you would initially realize. You can't trade gold effectively with a 500 Rand account, for instance. You need at least sort of 10 grand to trade just the smallest contract available. The asset it's fairly volatile. The margin requirements are higher than forex, obviously the contract size is far higher than a forex account as well. So just bear that in mind if you're looking to trade your commodities, especially gold. Just some interesting stats here. The broad consumption distribution, 50% of the world's gold goes towards jewelry, 40% to investment, 10% to industry, and some of it even gets eaten as well. All right, the value of gold never really depreciates, and that's why when currencies are failing or being sold off in the markets because of bad economic news emanating from a particular zone, we see a new kind of gold rush as traders rush into this safe haven currency. If you have the fundamentals at work, you can use the technicals to determine where to make your entries. A classic example presented itself on June 24, 2011. At this time, Greece and Europe were making traders very uneasy with all manner of different economic news, triggering a gold rush. Okay, and that was all based off the fundamentals. All right, so what we did was we used that in conjunction with our technical indicators, and in this particular example, we used two indicators, one of which was the ADX, and the other was a parabolic SAR. Both of these indicators you will find on your MetaTrader 4 platform, and this combined to form a very strong bullish entry signal supporting the fundamentals. And this means it would have earned a trader with a standard contract position on this trade of 42,000 Rand. Not a bad return based off these various indicators. And on the next page here, we have an example of that actual trade example. Right, so if we have a look here, I've basically highlighted it in yellow, the points where we saw it kicking off not only the 100-day moving average, all right, which is the blue line here, but as well as the indication of the crossover on your ADX, as well as a good indication there by the parabolic SARs, along with, as well, some good Japanese candlestick formations allowed us to obviously make this nice move up towards the upside here back in 2011. All right, obviously I've used one or two other sort of little indicators there apart from the parabolics and the ADXs, but all of that combined to form a pretty good idea, used along with the fundamental impact in the market as well. All right, so in terms of gaining exposure to gold, the first thing I always say is don't always buy too much. Gold's supposed to be a safe haven asset that will retain at least some of its value, other than that other asset classes are falling in value. So the likelihood of equities, bonds, and asset classes falling in tandem has to be assessed before piling into gold. All right, so obviously all of these things have various different relationships and inverse relationships. So we need to have a macro understanding of the market as a whole before we can really get a view on gold as well. Most people hold gold as insurance rather than a belief that the global economy will combust. Gold holdings provide no income and the price can be volatile, historically holding up best when equities are falling. All right, so just bear that in mind. We don't get any dividend yield or anything out of gold. You basically just pack it away for a rainy day, and hopefully the price of gold does increase. Most people should hold no more than 5% of a portfolio in gold, while older or more conservative investors should only have about 3%. So we're talking about physical gold here. However, high-risk clients who have more of their portfolios in equities tend to hold higher amounts of gold as well, just as a sort of a gold hedge, if you would like, just to protect the equity portfolio a little bit. All right, okay, in terms of holding physical gold, specialist providers will buy physical gold and store it in vaults or nominee accounts for investors, giving them the security of knowing the gold is safe and obviously held in their name. But the disadvantage of holding physical gold, as I already mentioned, can be that it's difficult to sell quickly and upfront costs can be high. However, after 6 years, it becomes cheaper to hold physical gold rather than an ETF which has ongoing annual charges. The other final exposure to gold is to obviously buy the gold stocks. It's an indirect way to gain exposure to gold, I guess. And fund managers point out that the share prices of mining companies have suffered recently amid equity market volatility, making them look better value compared to the steady rise in the gold price. That was obviously a few months back. We've obviously the gold price come off a little bit recently. Okay, this is just some market commentary that I recently got from Marcus Grubb, who's the managing director at the World Gold Council, and he basically quoted on saying the price drop in April, fueled by non-physical moves in the market, proved to be the catalyst for a surge of buying that has left many retailers short of stock and refineries, introducing waiting lists for deliveries. Okay, so we're talking about physical gold here. Putting this into context, sales of bars and coins, jewelry, and consumption in the technology sector still make up 81% of the market. Right, to continue on with the quote, what these figures show us is that even before the events of April, the fundamentals of the gold market remain robust with growing demand in India and China, central banks consistently adding gold to their reserves, and strong buying of investment products such as gold bars and coins. Okay, so if we just take a step back and have a look at the world gold holdings, which is as a percentage of the share of national reserves, this was as at March 2013, and there we can see South Africa on the right-hand side there, sitting at number 28 in the world in terms of percentage of the reserves that they currently hold. Number one, obviously, being the States, Germany in there at second. And there we can basically see, I mean, you wouldn't really have thought that South Africa would be so far down the list, but there we sit at number 28. All right, this is basically gold demand in 2013 from the first quarter. This comes from Thomson Reuters. The first little chart that we'll have a look at there is gold demand in tons and versus the gold price. And this is going back through to 2010, how we compare to the initial quarters going back to 2010. So we're pretty much around about the same where we were back in 2010 in terms of gold demand. If we have a look at gold demand and in tons and the value on the second chart there as well. So we're in a very much a similar position in terms of the actual demand itself. However, obviously we've got a little bit of a difference in terms of the value and the actual gold price itself. So even on the, going back to the first chart there, we'll see that even though we had similar demand in tons, the gold price itself has increased significantly since 2010. If we go down to the bottom left chart there, we will see gold demand by category in tons and the gold price itself. And you'll see that the majority of the demand by category goes through to the jewelry sector, and then obviously followed up by the investments, and this obviously bears out as to what we said earlier. And then finally on the bottom right, we have our jewelry demand in tons and value as well. So we're pretty much back at Q1 2010 levels, but once again, obviously our value has increased substantially in terms of the jewelry market itself. Just a quick little one here, investment demand by segment. So obviously the majority of it going through to gold bars, followed by gold coins and then gold medals, and then obviously to a lesser extent, the ETFs and other related products, obviously because it's not physical gold that they're taking on there. All right, so in terms of regional investment and investment demand in tons throughout the world, the majority of it is going through to China and India, followed by Europe, which doesn't include, countries such as Russia and the like, and then followed by the USA itself. Right, in terms of gold production, and these are the latest figures that we could find as at 2012, and these are the top 10, well, top 8 biggest gold producers in the world. All right, and what stands out there quite significantly is the drop in tonnage that South Africa has produced. Obviously, a couple of reasons for that. Number one has to be obviously the strikes and the issues we've had with the mines. But as a whole, if we have a look at the big producers here, gold production of these producers decreased by about 0.31% over the last year, whereas at the same time, the world gold production increased by 40 tons to 1.5%. So it's the smaller countries that are actually producing or growing, in terms of their tonnage that they are pulling out the ground. Right, so just some technical factors here, looking at the gold price itself, and this is dating back a few years back to 2008. This is a weekly chart. And what we have here is the purple line designates the 100-day moving average, and the blue the 200. And obviously, what we see happening here is that the 200 level has been broken, but it does seem to be finding a little bit of support on these Fibonacci levels. Let me actually pull up my little indicating tool over here, my spotlight. So basically, we're doing a Fibonacci level here at 50, and it seems to be getting a little bit of support around these levels here. As of today, the gold price is sitting at about 12.91. So I think we probably might get a little bit of range bound situation between these two levels for a little bit. However, once it breaks through the 38.2 level, we should hopefully see it come back up through to the sort of 1500, 1600 levels. All right, but just bear in mind, and I've just drawn it in here, medium-term resistance as well. Obviously, remember what happens with supports. Once a support gets broken, that will then in turn become resistance. So we have that line forming there. So that's why I say 1450 to 1500 could be the next kind of resistance level that we can expect just on a sort of a medium term. Right, okay, then just to have a look at other things like ETFs, and this is basically an index of gold ETFs throughout the world. And what we see here, once again, this is going back through to 2006. This is a 7-year-old support line that we saw coming through here, and this I think is going to probably be challenged in the next few weeks or so, I would imagine, if the gold price doesn't tend to come back up. But really, if it breaks through that, then we should see it come through back here to this technical line, this deflation crash line that I've basically drawn in here as well. This was basically the original support line that got broken back last year. There was a nice support line there that we thought might be fairly decent, But as you saw recently, this just got smashed through that. It smashed through all of our levels, but once again, it seems to be getting a little bit of support here at 61.8. So hopefully we can see this sort of ambush zone being sorted out and moving back to the upside. All right, so obviously something to always talk about with commodities is seasonality. All right, so seasonality occurs when there's a cyclical event that drives the supply-demand fundamentals consistently during certain times of the year. Now, what I've got above here on this chart is obviously dating back 34 years, maybe a touch longer. This is going back to 2007 to 1974. But it basically gives you an idea of when gold prices are fluctuating at what specific times of the year. All right. Now, traditionally, advances in gold during its period of seasonal strength is attributed to precious metal fabricators in India who purchase bullion to make into jewelry for the Indian wedding season that starts this year in the first week in November. India is the second biggest consumer of gold jewelry in the world, behind China. Demand for gold in India is higher than usual this year because investors are buying gold to protect against devaluation of the rupee. Recently, India imposed import tariffs on gold in order to slow imports of gold bullion. All right, so in terms of the period of seasonal strength for gold bullion, it's rapidly approaching, and I love this chart because it gives me a great idea of how the gold has moved over various different time periods. And what I basically have here is Thackeray's 2013 Investors Guide notes that optimal time to invest in gold bullion for a seasonal trade is from July 12th through to October 9th. Okay, this particular trade has been profitable during 12 of the past 15 periods. So what we have on this chart over here is a 5-year, a 10-year, and 15-year seasonal study. The 5-year being in blue, the 10-year in red, and the 15-year average in green. And you can see here from July all the way through to October itself, we can see there really is a nice consistent uptrend in the actual average gold price over that period of time. So if you're looking to structure a trade over this period of time, obviously I would make sure that the money management that I commit to the trade is correct, so I can write out any sort of down movements that I might have. But if you look historically, this has proven to be the best time to invest in the gold price itself. Okay, so let's just talk a little bit about the gold and silver relationship. There are pure assets and elemental association. So if you have a look on basically a time, in fact, I'm not even going to talk about that. It's basically, they're obviously closely related. Silver is 17.5 times more abundant in the Earth's crust than gold. And from 1792, they basically set that ratio in the US of 1 to 15.5. All right, that has changed quite significantly. If you have a look at the 20th century, the average ratio is 1 to 47. All right, so the higher the number, the cheaper silver is to gold. All right, traded bullion market is 18 times the scale of the silver market itself. Silver is often called the poor man's gold as the price per ounce is lower, though a lot more volatile than that of gold. But just be aware, silver has been more volatile than gold in the past. It's also affected by different factors to gold. Silver is widely used as an industrial metal, so it will be affected by any slowdown in production if economies falter. And here basically we have the historical relationship. This dates back to 1915. It is inflation adjusted as well, gold and gold, and obviously silver and silver there. A lot of you might just be questioning what this this move was here in the middle here. Just you see that massive spike in silver there. And quite a nice little anecdotal story was it was basically called Silver Thursday, and it was created by two brothers, the Hunt brothers, who were billionaires, and they were sons of a Texan oil billionaire. And what they try to do is they try to corner the market in silver. Basically what happened was they were very close on defaulting on their silver positions. They had bought a whole lot of silver futures. What essentially happened was a whole bunch of bankers got together, and I think they raised around about $1.1 billion just to try to bail them out. And obviously 1.1 billion back in 1980 was a fairly significant number. These chaps, obviously the whole market saw this as a potential issue, for a default in the market itself, and obviously traders sold off all their silver positions. So if you want to find out more, just go Google Silver Thursday, and you'll find out the full story about that. Okay, obviously difference in fundamental requirements has prompted a decrease in the correlation between gold and silver. As you can see through the years, there was a fairly nice correlation between the two, but as we've kind of progressed through 2008 onwards, we've seen a lot less correlation between the two as we've looked to achieve different things with the different products. All right, so now we're going to basically look at gold and how it's related through with the US dollar itself. Okay, so it's a basically inverse relationship with the US dollar. When the US dollar strengthens, gold should in theory weaken. If some of the major currencies, i.e. the Aussie dollar, the euro, or Japanese yen, strengthen against the US dollar, gold prices will invariably be boosted. All right, just a trading tip for you here. When the value of the US dollar is on the rise or fall, it's a good opportunity to prepare for a gold trade. Okay, so let's have a look at this now. This is a chart dating back to 1974. Compares the movement in the real dollar index with gold and oil prices. And I've actually taken out the oil price just so you can find it a little bit easier to see. In 1974, the gold series is adjusted for CPI inflation, and the real dollar index is adjusted for the relevant trading partners' own currency inflation rate. So you can see like they really are inversely proportional to each other. So just bear that in mind as I referred to on the previous slide. Okay, this is quite a nice little anecdotal story here. Basically, we said, right, well, is gold going to $3,000? Only if the bubbles repeat themselves. And what we've got here, this chart tracks the performance of gold since July of 2002 against the three largest bubbles of the last 40 years. Those being the NASDAQ, from 1990 to September 2002, gold in December 1970 to February 1985, and then oil from February 1999 to present. Okay, so past bubbles have shown strong but steady growth for the first 7 to 8 years before moving into a hypergrowth phase for the last 18 to 24 months. So that basically it needs to replicate that, and I can't really see that happening at this point right now. For gold to get up to that $3,000 level. I think we're going to hover around here for quite a while longer. All right, so we're going to talk a little bit about US bullion versus the JSE gold stocks now. This was up until 2012, this particular chart, basically showing the gold stocks index versus gold price itself. And you can see there's been sort of gross underperformance of the gold stocks there. All right, so let's just have a look at some of the big five throughout the world. The top of the pops is Barrick Gold, which is the largest gold producer in terms of gold ounces produced. It's headed up in Toronto. Goldcorp is based in Vancouver, which employs around about 14,000 people throughout the world. It's got mines throughout the world as well, Canada, Mexico, Central and South America. Newmont Mining Corporation has mines in 5 different continents and is the world's second largest gold producer. Newcrest Mining is an Australian-based corporation which engages in the exploration, mining, and sale of gold and gold copper concentrate. It's Australia's leading gold mining company, and its operations have expanded beyond Australia, for example, Indonesia. All right, and there we have our first South African gold stock, Anglo Gold Ashanti. So those are the top 5 right now. And obviously what you would see missing here are guys like Harmony, who used to be involved here. But let's just take a now closer look at 3 of the top South African companies and what their story is. All right, so I'm going to talk about that on the next slide. All right, but let's just firstly understand that there's obviously been gross underperformance with the gold mining stocks in South Africa. What you also must remember is that Bullion doesn't omit dividends, doesn't have interest calculations. The shares tend to absorb all the extraction costs. So labor, utilities, exploration, bureaucracy, and badly managed hedge books. So just bear that in mind. And then obviously what we have a lot of people venturing off into as well is ETFs role as an investment vehicle. So there are alternatives that people have been going towards rather than trading the bullion or the actual mine stocks themselves. All right. So as I've mentioned here, there's a profound preference for metal rather than paper. So it's almost like there's a reversion to an implicit gold standard argument once again. Okay, so let's just take a look at the top three South African gold mines: Anglo Gold Ashanti, Gold Fields Harmony as well. All right, in terms of Anglo Gold Ashanti, it's the world's third biggest gold producer, but it has very high cash cost per ounce at 3.944 million ounces in 2012. So that's obviously extremely expensive. Anglo Gold is also South Africa's largest producer of uranium as well, a position that was strengthened in July 2011 when it acquired 20% of Canada's first uranium. Goldfields, it produced 3.25 million ounces of gold in the year leading up to June 30th, 2012, roughly the same as it did in 2010. Its largest new mine has the potential to produce at a rate of 1 million ounces annually, so it produced 175,000 in 2009. It is South Africa's second leading producer, and then there's good old Harmony down at the bottom here. It was the fifth largest producer of gold in 2008 and has since fallen off a bit. So production was 2.33 million ounces and versus 1.56 million in fiscal 2010. So I mean, like you have seen a massive decrease, and obviously for those of you who've been watching the Harmony gold price, you see it's fallen off significantly. Okay, so gold miners globally have been hurt by the bear market in bullion. Bullion has plunged 24% since March, the biggest 3-month fall on record because of an improving U.S. economy. All right. Quote here from Peter Archibald, of London-based credit analyst at Fitch Ratings. Gold companies are essentially a leveraged bet on the gold price, and particularly for comparatively higher cost producers like the South Africans. When the gold price falls, their earnings fall exponentially. So that's the way that the chaps are viewing South African stocks overseas. So they basically tend to feel that it's obviously massively leveraged in terms of trading our gold stocks versus the gold price itself. The companies are not only confronting slumping commodity prices and yields spurred higher by concern the Federal Reserve will start to scale back stimulus, but also face labor unrest amid demands by entry-level workers for pay to be doubled. Mining industry costs have outpaced inflation over the past 5 years, partly because of the strikes. So I mean that obviously has hit our industry quite hard with the strikes and obviously the unrest, which makes it a little bit difficult to convince foreign investors to come here and get involved with our mines. Costs for gold mines in SA are steeper than abroad because of high levels of labor needed to dig it into its aging mines. Okay, that's just always going to be a factor here. Which is why potentially we could see a lot of foreign investors pulling out of emerging markets here in South Africa. Okay, so let's just talk about the New Gold ETF. All right, it is South Africa's most successful ETF. All right, as you can see here, since inception, it's done about 17% on the right-hand side here. Those returns are annualized, just bear that in mind. Okay, it's got a market cap of about 17.5 billion versus Satrix, which has 7.3 billion. All right. Gold as a primary metal with certain monetary uses and investment merits tends to act as a contracyclical nature to most of other investment asset classes, making it ideal as a hedge product. The oft-repeated mantra is that when markets zig, gold zags. So obviously, as I've mentioned, gold tends to be inverse to everything else. With gold and other mining shares often suffering from safety, labor, regulatory, and state intervention issues in South Africa, direct exposure to commodities through ETFs such as New Gold is becoming the preferred point of entry, particularly for institutional investors. So there you go. I mean, you've got various different routes in which you can obviously access gold itself. If you're going to go the ETF route, this is probably the best route I would probably go. All right, and then just for those of you who are interested as well, it obviously comprises Sharia principles as well. Okay, so let's just have a look at this now on a chart situation. New Gold would be in red versus the JSE All-Share Index in grey. Gold is always worthy of consideration in long-term investment portfolios because it adds diversification and some alleviation of risk through reduction in overall cyclical volatility of the portfolio. So we can see here that it's been substantially outperformance versus the all-share index, which is obviously what you want when you're in an ETF. And then finally, now this is obviously quite interesting. This is New Gold versus the SA Gold Mining Index, percentages performance-wise, New Gold in red, the SA Gold Mining Index in grey, and you can just see there's just been an absolute bloodbath in terms of the gold miners, in terms of their percentage performance, going or dating back to late 2012. But the New Gold seems to be holding its own. Okay, so gold trading with Trader24. We have 4 ways in which you can access the gold itself. We have our MetaTrader 4 platform, our Sirix Web Trader platform. For those of you who want to trade on your phone, you can do so, as well as trading on your iPad. How is gold traded? Gold is basically traded in dollars and cents per ounce. One gold contract is worth 100 troy ounces. So, for example, let's say the current price of gold was $1,400 per ounce. A trader wishes to buy gold at that price and will later go on to sell it at 1,410 per ounce. All right. So the trader's profit would be the 1,410 minus the 1,400, which would give us a $10 profit, times that by 100 ounces. That would give us a $1,000 profit. Okay. So let's just go through it again. We're basically buying at 1,400. We're selling at 1,410. That's a $10 move. $10 times by 100 ounces will give us a $1,000 profit. All right, so we obviously give you a few tools in which to come up with a daily trade for gold. These should come through to you, our daily technical levels. We send our 2 emails per day. And these are all based off pivot points, amongst many other different techniques that technical levels that come to you. For those of you who don't know what pivot levels are, there is a webinar that I have recorded on YouTube, so please go and check that out. It gives you a couple of different strategies of how to actually trade using pivot points. And you'll get used to seeing these reports that come out on a daily basis, whether it's a short-term trend or a medium-term trend, intraday resistance and supports. So you should be able to come up with a decent trading technique from these reports. For those of you that are on our premium accounts, you also have access to the Trading Central website as well in its entirety. And what you have access there to is weekly commodity reports as well. So for those of you who are looking to get onto a premium level account, please, you need to invest with at least 10,000 Rand or more, and you will have access to these weekly reports as well. These reports also do contain information about indices, currencies as well. So there's a wide variety of things that you can obviously utilize there with those reports. All right, so just as a quick reminder, top reasons for trading gold. Obviously, you've got your leverage, so you can get greater exposure, more bang for your buck. You can trade any time of the day. It's pretty much a 24-hour-a-day market. That's a two-way market as well, so you can buy or sell on gold, so you can speculate in the change in price of gold. And there's obviously large liquidity, so it's easy to get in and out of your trades. All right, so that is basically it for tonight, people. That I've obviously given you quite a long fundamental view of how to trade gold, things to bear in mind about how to trade gold. You use these things in conjunction with the tools that we give you and your technical analysis, and that should be more than sufficient to come up with a view. I'm going to stay online now for a little bit just so you guys can obviously field your questions, and I'll try and address them as soon as I can. For those of you that need to work out how to do questions, you can obviously just do that on the Citrix little portal there. If you just go down to questions, you can just type it in, I'll read it out, and then I'll answer it in turn. Got a question here from Matt. Tell us about gold-related counters. Obviously the one big relationship that we obviously mentioned was, just the inverse relationship between gold and dollar itself. I would also suggest having a look at the relationship between the Aussie dollar and gold itself. Very strong correlation between the two there. So that's probably one of the trades that I would certainly look at if I'm looking to trade the two in conjunction. Can I suggest a suitable strategy there from Mr. Mudley? Listen, I mean, it's really a case of it's a fairly open-ended question there, quite honestly. Once again, you've got to identify what type of trader you are. So as I guess what you can assume from the way that I've talked about tonight is that I'm not so much a short-term trader with gold, simply because I like to look at a macro understanding of it. So as I mentioned earlier on, statistically, if you have a look at gold from June through to October, there should be a significant increase, and it's been proven over a sort of a 5, 10, and 15-year period that invariably gold does increase there. So what I would probably do is try to format a trade here, and I would build up this trade. I would try to get a core position in gold, and I would build that trade up over time. So just adding to it, moving my stop losses, and just actively managing the trade itself over the course of the period through to October. So that's probably what I would do from a fundamental level. If you're looking for a shorter term time frame, just having a look today, there seemed to be a little bit of resistance at around about 1291, 1292. You could potentially short off that level there, looking for it to head back down to, your 1280 level again. I mean, that's roughly a, sort of $10 to $15 move, which would certainly be more than sufficient intraday trade as well. But, like as you will hear me say throughout most of my presentations, is that I love to look at price action. All right, so I love to see how people react off various different price levels. And as I mentioned before, prices are cyclical. They will repeat themselves. So if I see a horizontal support or resistance line that gets formed, I will maintain that on my chart throughout. All right, so like if there was a significant support level that happened for me 2 years ago, and I was an intraday trader, and I woke up one day and came through and I saw that level there, I certainly would react off that level. Matt, just other big drivers. Well, the biggest driver is really the Indian market. That's why historically we see that thing happening. It's all about the Indian wedding season. So that really is the biggest driver from a fundamental point of view. That's the one that I would focus on. There are a couple of different websites that are pretty good in terms of looking at gold. I think there's a website called Golden Oil. I mean, if you Google it, you'll find it. You've got the World Gold Council as well. Another, gosh, I'm just trying to think. There's a whole host of websites that you can really just sort of search around for, which you're always going to get a view from various different places. I don't like to spread myself too far because I obviously don't, I don't really want to get too confused by everyone's various different points of view. Another quite useful thing that you can use here as well is that commitment of traders report, which is the COT report. I have talked about it briefly before, but I think what I really need to do is for next week's webinar, I'm going to just talk solely about the commitment of traders report. So please, guys, go check out COT report, COT report. You'll get onto website there whereby you can obviously, it's a little bit tough to kind of work your way around, but if you Google Crop Report, there are a number of fairly good explanations of how to interpret it. But if you use that in conjunction with your average analysis that you do on a daily basis, it'll actually put you in quite a good position, I think, to come up with what traders are thinking in terms of sentiment. Are there any more questions, guys? Any more questions? Shall I call it for a night? Keep an eye out. Once again, just a reminder, please go check out the webinars that are recorded on the YouTube channel. We are getting some really good feedback there from clients that are going through there that need that kind of education. And then obviously, if you have any other questions, please visit, there's my email address down below, mark@trader24.com. But certainly, please just keep your eye to your email addresses about up-and-coming webinars. But thank you very much for listening tonight, guys. Hopefully you found it useful. Bye-bye.